Good afternoon, distinguished clients, ladies and gentlemen. It is my pleasure to welcome you all to Stanbic IBTC Holdings webinar presentation on Nigeria's economic outlook for the second half of the year that we have themed Looking Ahead. My name is Muyiwa Oni, and I am the head of equity research for Stanbic IBTC Bank. Before I hand over to the Chief Executive of Stanbic IBTC Bank, Dr. Demola Shogunle, for the opening remarks, I want to highlight some housekeeping rules for our Q&A session. All participants will be muted, so please type in your questions or comments in the Q&A tab. That's the tab with the question mark sign. We also plan to send the presentation to clients and participants at the end of the session. Once again, it is my pleasure to welcome you all. I will now call on Dr. Demola Shogunle to give the opening remarks.
Yes, thank you very much, Muyiwa. Good afternoon, our dear customers, ladies and gentlemen. It is with great pleasure that I welcome you all to our webinar presentation on Nigeria's economic outlook for the second half of 2020 that we have themed Looking Ahead. The COVID-19 pandemic has made the year 2020 a challenging and volatile year as institutions and individuals have found it extremely difficult to plan. Looking ahead beyond our current situation has become very daunting. While the world continues to battle the medical challenges of the pandemic, the economic fallout continues to eat deep, with economists' forecasts showing the deepest global contraction since the Great Depression. The IMF recently revised downwards its global gross domestic product forecast to a contraction of 4.9%. from an estimated contraction of 3% in their April outlook report. Capital market volatility has been unprecedented, with oil prices printing negative for the first time, as measures such as social distancing and lockdown have reduced global demand for commodities, while creating supply shocks due to value chain disruption. The steady rise in the number of infections and the time to deliver an appropriate vaccine imply that the uncertainty and market volatility are likely to continue over the near term. COVID-19 cases continue to increase in Nigeria, even as testing intensifies. However, the negative impact of a total lockdown on the economy has been harsh, hence giving government limited choice but to reopen the economy while encouraging social distancing. For the Nigeria economy, like the global economy, analysts and the managers of the economy agree that the economy will be in a recession in 2020. However, forecasts range from a contraction of over 2% to over 5%. Government revenues have contracted considerably in an environment that requires a considerable amount of stimulus. Hence, we have seen a material increase in government borrowings to close the shortfall. Beyond fiscal stimulus, monetary stimulus package north of 2 trillion naira was put together by the Central Bank of Nigeria to ease the impact of already difficult macro conditions on companies, institutions, and individuals. In keeping with one of our values, serving our customers, we have put together this session to provide more insights on the economy, which we believe should help you plan and navigate these challenging and uncertain times. I do not think there is an expert more qualified to do this task than Dr. Doyin Salami. I'm sure most of us know Dr. Salami very well. However, I will present a very short profile for some of us who are not as familiar with Dr. Salami. Dr. Salami is currently the chairman of Economic Advisory Council, constituted by President Muhammad Buhari. The Economic Advisory Council is tasked with the responsibility of advising the president on matters relating to economic growth, economic policy, and fiscal analysis. Dr. Doyin Salami is also a senior lecturer at Lagos Business School, where he leads sessions in the economic environment of business. He was the academic director of the Global CEO program. He was a member of the Monetary Policy Committee of the Central Bank of Nigeria between 2010 and 2017. He also served as a member of the federal government's economic management team during the administration of President Yar'Adua. He's an executive director of the UK-based African Business Research Limited. In addition to teaching, Dr. Salami consults for multiple organizations. His consulting activities include assignments for DFID, World Bank, UNIDO, USAID. Good afternoon, Dr. Salami, and thank you very much for taking time out to engage with our clients today. I understand that this is a very busy time for you and your team as you chart a recovery path for the Nigerian economy. As President Bill Clinton once said, and I quote, "In the new economy, information, education, and motivation are very, very important, and they are everything." Unquote. A notable futurist recently told us that in the post-COVID-19 world economy, 3 ingredients will be very essential, namely trust, social capital, and collective intelligence. For our customers, I believe the information you will gain from this session will be educative and help you as business leaders to motivate your teams to success. After the presentation, Dr. Salami will also take out time to address your queries and questions. This question and answer session will be moderated by our economist, Bolawan Taiwo. So at this point, it is my great pleasure and honor to call on Dr. Salami to make his presentation. Thank you.
Right. Demola, thank you very much indeed. And a very good afternoon to you, distinguished ladies and gentlemen. Let me perhaps start on a note that essentially is to reinforce some of the ground rules that may have been announced earlier. I will not be speaking for the government because I note that in Demola's first intro is to introduce me as chairman of the Economic Advisory Council, which is a statement of fact, but I am an advisor, and so it's not my job to speak for the government, but I will share my own views as they are relevant. So the whole idea of this session is that over the next 25-30 minutes or thereabout, I will share my thoughts around the outlook for the economy in Nigeria going forward. I think, as he has rightly said, there are, as Demola has rightly said, there are a couple of things that we should bear in mind. For me, what you see on this first slide is essentially the way I characterize how Nigeria's economy is driven. Essentially, external factors are as important as internal factors. And there are 4 key external factors that I typically pay attention to. I'm not saying these are the only ones, but these are the ones that I feel are most important. And then on the domestic side is the policy agenda, which is why we have put it at the heart of our map of Nigeria, as you can see. Now, so when we therefore talk about COVID-19, given what I have said about global conditions and their impact on Nigeria, then we shouldn't be surprised that, like the rest of the world, Nigeria is expected to contract, or to see her economy contract over the rest of this year. If you had paid that, if you're someone who pays attention to Nigeria's numbers, you'd have seen that in the first quarter of 2020, growth was 1.87%, which was lower than it had been in quarter 4 2019, which essentially showed that the economy, even ahead of COVID-19, was fairly fragile. And so COVID-19 comes along and, shall we say, simply complicates an already challenging situation. So that's the first thing. As we look around the world, one of the key interesting dimensions that I, shall we say, take some comfort from at this point is that, yes, everybody is headed into a recession. But I think across the world now, there is an increasing drive to try and reopen economies. And it is on that basis that countries like ours will see, in my view, opportunities that we might just be able to take advantage of. So that's, if you like, on the positive side of all of this. Yes, we know almost 10 million infections. And across Nigeria, our own numbers, notwithstanding the limited tests that we have seen, also are not doing that well, even with the limited testing. Okay, so having said all of that, I think there are a couple of things on the international side that really do concern us. And the first of those is oil prices. And Demola, you made the point about oil prices going negative. Of course, as economies reopen, the demand for crude oil will improve, even if at this point strategic reserves are pretty much filled up around the world. But the prognosis, I'm not an oil analyst, but as I use the data of these analysts, one of the things that's interesting is that there is currently a view which says the glut in the oil market probably dries up at the end of next year going into 2022. But that's going to be, again, driven in part by what kind of investments we see globally in that sector. But what is clear at the moment is that we're down. Don't forget, in January, oil was almost $70 a barrel. Currently, we're somewhere around about $40 a barrel. So we're down currently relative to where we were at the beginning of the year. So governments across the world are trying to spend money. But what is clear is, no matter how you look at it, the world economy is currently troubled at the moment. Okay, so that's the backdrop as far as we are concerned. But then there is also an interesting dimension to this backdrop that I think might provide opportunities for Nigeria if we pay decent attention to it, is that there is a significant pool of funds which we find invested in negative yield assets, which means that perhaps with the right policies and the right outlook, then Nigeria might yet find some succor as far as global resourcing is concerned. Bear in mind that before COVID-19 struck, we were looking at investment at 15% or thereabout, 14-15% of GDP. At those levels, growth was never going to be very significant. And so one of the challenges that Nigeria faces at the moment is, how do we stimulate investments significantly? But we'll come back to that, shortly. Now, let me quickly, run through the domestic, our domestic context. It's a fairly, we're fairly clear as I said earlier, about the weakness of the economy. We were just recovering from the 2016 recession, as I said earlier, 1.87% Q1, 2020. But one of the things that is beginning to be defining of the domestic environment is rising prices. Food prices have remained in double digits, about 15% or thereabout. But core inflation is itself now, last set of figures, in double digits, I think 10.1% or thereabout. Now, when you add higher prices to high unemployment, then you can understand why the consumer segment of the economy is under significant pressure. Now, if you look here, because it might be, this is one of those areas that sort of concern me a bit. We need the investment, the business investments in this economy, as I said, about 14-15%. We need that to grow quite significantly. But as I look at this graph, and you look in the second row at the right extremity of that row, one of the things you also see is the gap opening between consumer price inflation and the GDP deflator. Now, the point about that is that with consumer price inflation, what companies are always looking for is for consumer price inflation to be higher than the GDP deflator, because the GDP deflator is what measures their own costs. Now, we have seen a great deal of volatility, but at the heart of it is a tightening of that gap, which simply tells you that corporates are also hemorrhaging profits at the moment. Yeah, they're trying to do their best essentially through cost management, but it still tells you that we are in a fairly challenging situation as far as corporate margins and corporate performance is concerned. Well, so in terms of the real sector, we're headed into a contraction. The good thing about what we are seeing at the moment is that the projections say the contraction is not likely to be long-lived, but we'll come to that when we talk about the outlook. In terms of fiscal conditions, I think that's really where the biggest challenge does lie. Or one of the biggest challenges actually does lie, because what that speaks to is the amount of resourcing that is available to the government, to the Nigerian public sector. Don't forget that Nigeria's government is not just the federal government. The federal and the state governments are to be regarded as one. And one of the things that we're already seeing is, even before COVID, we had seen an expansion in the deficit. Now with COVID and lower oil prices, we are seeing a much lower level of revenue accruals to the government. And the totality of that, the revised budget shows a deficit of about 4.5 trillion naira. Okay, now our external account too has weakened, not surprisingly, and we all expect that weakness might continue. Well, it's not might continue. We expect that weakness on the external side to continue throughout this year, beginning to improve in the course of next year. Okay. Well, as far as financial markets are concerned, one of the more interesting dimensions of this for me is, as I looked at credit to the private sector, hasn't been as badly affected as one had imagined that it might be. Yes, early on, we had seen a significant, a sharp dip, but I think since then, as you look, the graphs on the top row, the middle one, does show that, well, okay, it appears that credits to the private sector has not been as bad as some of us had feared that it might be. Where, of course, there is a challenge, and we cannot run away from it, is that the reduction in oil prices, of course, does put pressure in terms of access to foreign currency. So the reserves, and by the way, when you look at the reserve numbers, yeah, it's actually growing a bit, but the inflows from Nigeria's borrowing from the multilaterals has provided some buffer. Now, in terms of the outlook, there are a couple of things that I think we all need to pay attention to. And I think the first of them is indeed, let me just, I'll come back to this in a minute. For me, we have to understand when we talk about COVID-19 and the economics or its economic impact, what you see here is our sense that, yes, it started as a health crisis, but it has now morphed into to encompass economic challenges, humanitarian challenges, and security challenges. And this is not a Nigeria-specific a set of Nigeria-specific consequences. This is what you see across the world. And so the reason why I draw your attention to that is as we go back and look and say, okay, so what's the outlook in the second half? I think one of the interesting dimensions of the outlook is going to be, so what happens to this pandemic? How quickly can it be contained? In some parts of the world, I think over the weekend, the numbers out of the United States actually do give some cause for concern. And so it's a question of, all right, so what happens to this pandemic? And what is a post-COVID scenario looking like? There was a conversation that I was part of earlier this morning, and a colleague of ours in his last comment in that discussion said, what makes you guys think that a vaccine will be ready quickly enough? And what makes you think that a post-COVID world will not actually imply we have to live with COVID-19 rather than eradicate COVID-19? Now, I hadn't thought about that, to be frank, but I think it's something that we'd all have to start adding as a scenario in terms of all the planning and all the thinking that we are all trying to do. This is a new area. We're all, as I say, arriving here for the first time, and so we're all trying to learn, to figure out what's going to happen and what should we be doing to it. So how does the pandemic evolve? How does business and consumer confidence evolve? And what does normality look like? So that's the first set of questions that in terms of driving an outlook. For Nigeria, don't forget, I put 4 things out there on the on the international arena in the international environment that would affect what might be the influences of our own outlook. And of course, oil is one of them. Even though we have in the past 3 weeks or thereabouts seen a recovery in oil price, and fortunately also we have seen a recovery in terms of Nigeria's export numbers. One of the things that I have tended to look at over the last couple of months is the gap between Nigeria's production of oil and her exports. And the last set of numbers, I think, published by DPR suggests that that's gone down from well over 200,000 barrels per day difference to just about 70,000 barrels per day. So it suggests that perhaps we're beginning to see better participation of Nigerian oil in the marketplace. However, no matter what you say, don't forget what I said earlier. Oil had been almost $70 a barrel at the beginning of the year. And in our Q1 numbers for GDP, oil was actually a major reason why the proportions, while the numbers were 1.87%, oil, I think, had grown at about 5.6%. So you can understand that once oil goes down, the non-oil being fragile, we will certainly see a recession. Now, in terms of the domestic economy, we need to be quite mindful of what's happening to the various components of the economy. So when we see Q2 numbers, then we will have at least a first glimpse at how badly COVID-19 has affected some of the key sectors. Don't forget, Nigeria has 46 sectors, but 6 of these are responsible for about 75% of total output. And so there are some sectors that you can, without thinking about it, you're clear that, okay, these have been very badly affected. Education for one, aviation or transport for a second, entertainment, for a third. But what's more important as far as GDP numbers are going to be concerned would be to see what actually happens to agriculture, which is 25% of total output. What happens to trading, wholesale and retail trade, roughly another 17% of the economy. How badly was manufacturing affected by the lockdown, and also how badly was technology, the telecom sector affected? Of all the sectors of the economy, telecoms was one of those that was growing in double digits ahead of COVID-19. And even though all of us are now having to deploy greater use of technology, it'd be interesting to see just how much of a lift that has given the sector and whether that is able to counter some of the adverse incomes that we're also expecting. Well, oil prices we have already spoken about. Now, depending on what's happened to GDP, non-oil revenues could also find themselves significantly shocked as far as COVID-19 is concerned. I already spoke about the external account. Again, oil plays a significant role therein. But it's going to be interesting, and that last point that we make here, which is that capital flows are awaiting exits as soon as restrictions are lifted. One of the things that's, in my view, going to be interesting to see how we can achieve is how can Nigeria stimulate capital inflows as opposed to capital outflows. So our challenge would be to staunch capital outflows whilst at the same time trying to stimulate capital inflows. I'm sure we're going to have an interesting discussion about that. And then, of course, on the monetary financial side, it's going to be a whole series of things that we would need to pay attention to. At this time, of course, whether or not the policy stance of the central bank would be important, and what we have seen in the immediate aftermath of COVID is a more accommodating stance by the central bank. It's also going to be interesting to see, and I note with some cheer the commitment by the central bank to harmonization of the exchange rate markets around the NAFEX windows. Anybody who's familiar with my thinking and my writing knows that I'm one of those who's argued for many years about the way I think the forex markets should be managed. Now, in terms of the outlook, the key headache, at the start of all of this, none of us was sure where things would go. I'm not saying that there's any certainty about anything. If you learn nothing in economics, the first thing that you learn is uncertainty. And if you're intending on success as an economist, the other thing you learn is to be very, very careful how you make projections. Now, the ideal, which all of us are hoping for, is a V-shaped recovery. In other words, sharp in, but also sharp out. And on the basis of the figures that, the projections that are out there, I've seen a whole raft of projections. The latest ones, of course, are these revised numbers from the IMF, which suggests that in 2020, the economy will contract by almost 5.5%, but that by 2021, we will see a 2.6% growth in the economy. Now, for me, that is a fairly sharp recovery, because don't forget that 2.6 would effectively be a growth between 2020 and 2021 of almost 8% in the economy. And that, for me, if we're able to achieve that, would actually be very, very good going. In essence, what it would simply be saying is, yep, the economy contracted like the rest of the world, but unlike certain scenarios which I have, you've got a U shape, you've got a W shape, you've got what is almost an L shape. If we're able to achieve a V shape in and out quickly, I think that kind of makes life a lot easier for everybody. As I said earlier, this is how I look at this, and I do thank my dear friend Biodun Adedipe for allowing us to use his representation. And so, in looking at things, we need to be clear that on the health and humanitarian side, there is need for continuing effort at containment and at relief. And so the work of the Presidential Task Force on COVID-19, especially the contributions by the NCDC and also the Ministry of Humanitarian Affairs, become very, very, very important. We cannot allow or afford to allow this pandemic to really get out of control. Now, in terms of the economy and plotting a path to recovery, in my book, this, as this, it is, many have referred to this over the past couple of months, how it is that we should not waste a good crisis. In other words, we should make the best of this in order to try and re-stimulate both the policy framework and the characteristics of the Nigerian economy. And in my view, in plotting a path to recovery, there are a couple of things that are pretty clear. Any which way we look at it, we need to be able to mobilize resources. Remember the point I made about investment levels being approximately 14-15% of GDP. It's important. Nigeria's path to sustainable recovery lies along that which speaks to significant mobilization of resources, both domestic and international. And so we're going to have to think through measures that enable domestic wealth holders as well as international capital holders to have enough confidence in this economy to be willing to invest. It's also important in this whole sustainable recovery effort to ensure that some of those questions around the role of the price mechanism in resource allocation are resolved. And I think we're already showing progress in this. Some will doubtless argue that, oh, this is rather slow, it could be much faster. But don't forget, it's when you sit in these conversations and you listen to different people that you begin to understand that there are quite an interesting array of views. And so when as one looks, we've all seen fuel under recovery eliminated currently, even though, and I think the government is very clear that its price modulation effort is how it wishes to continue with managing fuel prices. But at least for now, fuel under recovery has been eliminated. So what most of us tend to call the subsidies, not there. Again, I mentioned earlier the central bank's forward guidance on FX harmonization in a single window. And I think they are now working assiduously towards putting in place a mechanism that allows that not just to be achieved, but to be sustained as well. And then, of course, in the last, I think it's 1st of July, I think there is going to be a further review as far as electricity tariffs are concerned. Anyway, the key point that I'm simply trying to make in all of this is that this pandemic and the economic challenges that it raises provides us with an opportunity to try and resolve some of those outstanding issues that may have appeared intractable before now. Now, I think the biggest challenge that I see going forward is with consumers. Before now, consumers already had a major challenge. We had, as I said, higher prices, higher levels of unemployment. And so the real headache right now is going to be to try and minimize job losses in the second half of the year, and hope that as we turn the corner and the recession and exit the recession, then we also should see jobs being created, hopefully more efficiently. We're also clear that there are certain sectors that are going to be interesting to work in. Without doubt, like most other countries, I'm sure the healthcare and pharmaceutical sectors in Nigeria will come in for some attention, as I'm sure everybody is carefully watching. We're all now discovering that a lot of what we consume in these sectors are produced outside our borders, and many countries are beginning to feel very, very uncomfortable about that. So it's going to be interesting to see how Nigeria is able to plug into all of that. As I said earlier, technology is doubtless a major plus. It's going to be, when the second quarter numbers come out, it'll be interesting to see just how much of an expansion we see in that sector. And then, of course, it'd be interesting also to see to what extent that enables operators in that sector upgrade the infrastructure, upgrade and expand the infrastructure and the value chains in that. Doubtless, being able to sustain food security is also a very, very important element of where we go from here, because no matter what you say, if we are unable to sustain food security, that's a very long way, that's a very clear signal that the challenges around security might simply worsen. And so, looking at Nigeria's response as far as food security is concerned, and I'm sure you've all read the economic sustainability plan that's now been approved by the Federal Executive Council, and food security is certainly at the heart of all of that. And for some of us, it's also going to be important that the efficiency of the sector also improves, and the issues around post-harvest losses. I've just tried to, take the 6 big sectors to see what exactly might be the impact. I suppose the 2 that we all expect would definitely continue to suffer: real estate, roughly 7% of GDP, been in a depression for a bit, and I don't see that eases at this time. Oil and energy is where I'm hoping that, we probably will see a dip in 2020, but at least on the oil and gas side, hopefully the renewable side might begin to come into its own. All in all, my sense is this, that we're headed into, on the basis of projections that are available so far, we're headed into a recession, certainly into a slowdown, into a slower pace of economic activity, more likely to be a recession. But the numbers are also suggestive that it's not going to be a long one, that we're back in growth in 2021, and that growth could be as high as 2.5%. As I said, I've seen numbers that are slightly worse than that, but I think I'm happy enough to, as I've always done, adopt the IMF numbers anyway. Beyond that, my view is that this crisis gives us an opportunity to try and deal with some of the fundamental challenges that we face as a country, and that we're already seeing some movement in that direction. The key things are going to be as follows. Number one, that Nigeria does need to stimulate, first of all, staunch capital outflows, but more importantly, raise the levels of investment through non-debt finance to hopefully, if we could certainly get into the 25-30% range of as a proportion of GDP over the next 5 years thereabout, that would be very, very good. But what is important is we must stimulate investment if we are going to sustainably grow our economy. And as I said, some of those things that were hindering investments are things that are currently being addressed. So in summary, so that we can at least have a conversation, in summary, yep, heading into a recession, expected to come out of it quickly, but it also gives us, as I say, a chance to reset some of the lingering challenges that this economy has been dealing with. And what we are already seeing is an attempt across a series of dimensions to deal with some of these, especially around resource allocation and the role of prices. So let me stop there, and let's see what questions and comments are to be responded to. Thank you very much indeed.
Thank you very much, Dr. Salami, for that wonderful presentation and very insightful indeed. Just as a reminder to our participants today, if you have any questions, I can see a lot of questions rolling in already. If you have any question, there's a Q&A tab just to the right of your screen. Please use that tab to ask any of your questions. Dr. Salami, I mean, as you probably would imagine, there are loads of questions on the currency, on liquidity already. But before we get into that, perhaps we should start with the most topical issue in the world right now, of course, which is the COVID-19 pandemic. And we have seen quite significant responses, even from global monetary central banks. We've seen in terms of fiscal stimulus. With your knowledge about Nigeria and the Nigerian economy, and even when you take a read across the African continent and the lack of fiscal space therein, to be able to enact some level of stimulus that we probably have seen in other developed economies, what would be your policy recommendations, particularly in terms of trying to, one, limit the impact of the contraction in growth that we'll see this year, and perhaps giving support to the poor and the vulnerable during these times? Second to that question, Dr. Salami, is we have seen the government come out with its fiscal sustainability report, and this report seems to suggest that with a 2 trillion naira fiscal stimulus, or fiscal and monetary policy stimulus combined, we could see a contraction of just 0.5 this year. How do you assess that notion? I mean, we know the role that stimulus could play in trying to combat the level of contraction that you could see in any economy in general. But when I look at the global side of things, even with the amount of stimulus that is being put, some to the tune of 20% of GDP, it's still a fairly decent amount of contraction there you see there. So how do you assess that assumption, perhaps according to that report? And finally, on this topic, post-COVID, what would be your recommendations, particularly both from a fiscal and monetary policy side, in terms of trying to get Nigeria to that level of sustainable growth and development going forward? We'll just start with those three. Apologies, Dr. Salami, I'll be lumping a lot of the questions together because there are quite a number coming through already. Thank you.
Right. Thank you very much. One of the things as I tell anybody, when you look at my head and you see a shock of gray hair always remember that that also might mean my capacity to forget is probably higher than most. And so if you have to remind me of some of the questions, please, I hope you won't take any offense at that. Now, your first question, and I think that for me is really the key challenge that not just Nigeria, but African countries generally face, the absence of a fiscal space. Trying to create a fiscal space at this point is going to be very, very difficult. It doesn't matter how you do it. It's going to be very, very difficult. And in my view, there are really two dimensions that we are all going to have to reflect on as societies and as nations. The first is, how do we prioritize? What should be our areas of priority? Remember, COVID-19 poses a very difficult question to answer, the balance between saving lives and opening up economies. But in terms of the saving lives dimension, for countries like ours, the challenge is not so much saving lives as in, okay, lockdown or no lockdown. When you look, many of our people are daily paid. So containment measures that lock down the economy hit very, very significantly adversely in these dimensions. And as you say, in the absence of a fiscal space, what does the government do? In my view, the governments across Africa will have to sit down and say, over the next 1 year, what should be our priorities? From where should we move resources to where? Because so for me, it's going to be about a rearrangement of resource allocation given the constraint. So it's essentially a constraint optimization issue. The constraints, a very limited fiscal space. The challenge is, how do you, as you ask, or how do we, given that limited space, deal with the humanitarian challenge? Well, I'm afraid we are going to have to try and do two things. First, reallocate government resources in order to make a decent fist of the humanitarian side of intervention. The second is, we're going to have to make a very, very good fist of stimulating investment. And by the way, when I say the humanitarian intervention, I think one of the other dimensions that we have seen in response to COVID-19 has been the response of the private sector. In particular, we've seen the response of the private sector in terms of building healthcare infrastructure. And so part of the challenge, and also, shall I say, supporting lives, so you've got all manner of donations being made to in terms of poor, in terms of the poor. And so for me, that needs to be organized and so and as far as the government is concerned, how do you pull your resources? From where do you take resources and put it to this? Because this is necessary. Well, this we hope is short term. As I said, I am hoping we don't have to live with COVID-19. I am hoping that it gets to be eradicated. But the second part of it, and I think it is applicable to all, the three questions that you say, is we have to find a way of stimulating investment. It's as simple and as straightforward as that. You make the point about 2.3 trillion naira, and you ask whether it is adequate. Well, there is no matter how you want to look at it, it's the fiscal space is so constrained, and so the real challenge is, can we get enough confidence in the wealth holding class to enable investment? That for me is going to be a major determinant of how successful we are going to be in terms of dealing with COVID-19. Don't forget that a lot of things, especially in investment, have to do with confidence and trust. Even if we put a lot of money up there, and by the way, when you say put a lot of money up there, sorry, it's going to have to be borrowed. So question is, from whom are you going to borrow it? Right now, we're talking of a shrinking fiscal space. Imagine the government then having to borrow, as you say, okay, 10, 12% of GDP in order to stimulate the economy. Then you're going to see a crowding out of the private sector. And so the key challenges that you have to understand is COVID-19 poses some very, very acute problems for countries like ours that came into COVID-19, shall I say, with underlying conditions. And so for me, two things. One, a reprioritization of resources. Two, a concerted and sustained attempt to stimulate investment, mobilize resources, domestic and international, non-debt resources. Let me re-emphasize that, non-debt resources. I know that African countries as a whole are currently working or discussing how the fiscal space can be further expanded by having postponements on some of the obligations on some of the payments that they are due to make this year. It would be helpful if that were to succeed. I know these are ongoing. I'm sure they were taken as part of the G20. So for me, that, you know, the three questions that you asked, I'm not sure the third one, what was that?
Doctor, the third one is about the outlook post-COVID. What do you think the government should do? I think you started to address some of it already.
Look, the economic outlook post-COVID is a very simple solution. It's a straightforward solution. It's not a simple solution. It's a straightforward solution. It's about investment, and more investment. And it's got to be non-debt investments. It's only to the extent that we're able to stimulate investment that we're able to get this economy sustainably moving. Because what would be unfortunate is you come out and then you go back in again.
All right. Thank you very much, Dr. Salami. So I guess the answer there is quite simple: more investment and less debt. Dr. Salami, we'll move on to another critical sector now, which is the power sector, and I've seen quite a number of questions around the power sector as well. Of course, we know that, you know, from July 1st this year, just a couple of days from now, it is obvious that there will be increase in power tariffs. I mean, a lot of clients want to know and want to understand why is it so difficult for the government to back off this sector and allow it to be more, you know, price determined, as it were. Why is it so difficult for the government to allow, I mean, like you said in your presentation, a proper price mechanism that would, of course, drive maybe some level of competitiveness and provide efficiency in that sector. That's on one side. And the second is, how much gain do you think this increase in electricity tariffs is going to buy the country? Given that there are still a lot of structural issues. I mean, we've seen data that would say that, you know, there's still loads of Nigerians that are not paying for electricity right now. Basically still just trying to get, you know, the people that are currently paying for it to pay more. But how much gain do we get from that? And finally, on the power sector, how much impact do you think this hike was going to have on the inflation trajectory going forward?
All right. This is where a general economist usually tries to put a dead bat on everything, because I'm not a power sector economist. But anyway, let me share my own penny's worth. And believe me, it really is a penny's worth. As to the question, why are we struggling with allowing prices to vary, allowing tariffs to go higher? Well, I'm not sure that it is that we are unclear. After all, MITO, the multi-year tariff order, instituted as part of the power sector transformation plan, already understood the need for tariffs that reflect the cost of production. And of course, one of the biggest challenges, or a significant component of that, is simply a lot of stuff relating to the power sector has to be imported. I think as a people, we are going to have to wean ourselves away from a notion that we have tended to see the government as the provider. You know, over the years, we have become used to a public provision of certain things. And so the process of weaning us off that public provision is not that easy. I certainly, you know, see that if we are, and then so that's the first challenge. The second challenge, of course, is chicken or egg. people would argue that, okay, so you want prices to go up. All right, so are we going to get better service as a result of higher prices? Or is it just going to be an increase in cost? Now, there are a number of bottlenecks. Currently, the numbers speak for themselves. We're told that the generating capacity for Nigeria is something around about 13,000 megawatts. We're told that the capacity of the GENCOs, even though they have a nameplate capacity, they are probably not able to produce more than, generate more than 7,500. There are issues there, stranded gas, blah, blah, blah. Okay, now, so you can already see the numbers coming down. Beyond that, even the transmission capacity of Nigeria's network reduces further. I'm told it's probably around 4,000 or 5,000 megawatts at the moment. And then the ability of the discos to distribute that. So there is a whole series of bottlenecks that must be resolved, all of which require investment. And the way we have tended to think about these things is to say, okay, let government sort this out. And then when they have sorted it out, and they are able to, sort out all the bottlenecks, get the power generated, get it moving, get it distributed, and then come and talk to all of us, and we can pay. Now, my fear is that we are going to have to start rethinking this. Indeed, one of the interesting things that I have found over the, in the past year, when I've paid some attention to some of the issues, is that, believe it or not, in rural areas, off-grid power is actually being paid for by its users. And as what they are more concerned about is whether or not the quality and the regularity. And so there is a view that I think is gaining ground that, you know what, we are going to have to bail this cat, and which is why the movement in tariffs, it's not very popular. Nowhere in the world are price increases popular. And so anybody saying, oh, just increase prices, people will react. Especially, remember the point I made earlier, consumers are currently under pressure. And so when you say, just raise prices, that's one of the constraints to it. But my sense is that we will have, pretty much if we're going to get the sector in the face of limited government resources, if we're going to get this sector to grow, then we're going to have to see the kind of reforms that we are talking about. Now, in terms of the impact on inflation, well, don't forget, again, be careful, because sometimes, and these are some of the reasons that are advanced that mean prices don't change. What's the contribution of power to inflation? The biggest contribution to inflation is actually food. Currently, in the current basket, I think if you look at the NBS numbers for consumption in 2019, what we find is that food is somewhere around about 54–55% of that basket. And so when you talk about power and the impact, there is no doubt that it will have an impact on inflation. But whether that impact on aggregate inflation, as is sometimes suggested, I have my doubts.
Okay. Thank you very much, Dr. Salami. Yeah, so we're getting to the meat of the matter now, and which is FX and exchange rate. There are loads of questions on exchange rate. So I'm going to lump a number of them together again as well, Dr. Salami, if you don't mind. So there is obviously questions around what you think about the convergence of the different exchange rate regimes that we have. That's on one side. Second is what you think the true value of the naira should be. And the third part of it again is we see, the number of clients that have asked, so what do you think, particularly as corporates, what should they be planning with as an exchange rate number for the rest of the year? And finally, what's your view on the illiquidity we currently see in the FX market? Foreign portfolio investors not being able to get their dollars out of the country, And of course, there is still illiquidity even in the domestic market as well, compared to, of course, pre-COVID times. So what are your views largely on how do you think this illiquidity could be dealt going forward? Thank you, Dr. Salami.
Well, yes, I suppose FX was always going to be a major issue. Now, the question, sorry, can you repeat the first one if you don't mind? Your first question.
The question on the currency.
Yes.
That what do you think about the convergence? Do you
right.
think those rates should converge? Yes.
Well, there is absolutely no doubt in my mind that, and I think one can safely say that indeed, even across the government, even though I've said earlier that I don't speak for the government, but if we listen to to what's coming from various parts of the government, I think it's increasingly clear that there is a view that says multiple currency rates or multiple currency practice is something that Nigeria is moving away from. So, and for me, it's when you have a streamlined and harmonized exchange rate, it reduces all sorts of uncertainties and all sorts of risks. So in terms of what do I think about it, I certainly think it's a great idea, and I hope that we are able to sustain it. So that's the first thing. Then you raise the points about also what is the true value. I'm one of those who takes the view that value will be reflected in the markets. Now you can then come back and say, but come, it's not reflecting value. There are different ways by which you can say, by which you can create, for example, shadow rates and say, oh, should I use the nominal effective exchange rate? Should I use the real effective exchange rate? There are different schemes that you can use. But my sense is that Nigeria, has moved, and there is a view which says, as I said earlier, I think the governor is reported to have said that the rates will converge around the NAFEX, the rates in the NAFEX window. And so for me, that's pretty clear enough. Now, whether or not that needs to change from what it is will be driven largely by the central bank, because one of the things that you also have to recognize is that exchange rate management, we've always tended to look at it as essentially it's actually two sides. There's a demand side to it, there's a supply side to it. And one of the reasons why I am very, very, very clear in my the need to mobilize resources, domestic and international, for investment in Nigeria is that it eases that foreign exchange constraint. And so to that extent, as long as the managers of the exchange rate allow it flexibility, allow for a transparency in terms of its management, but also as they have committed to remove multiple currency rates, then I think what you find in the markets would be the reflection. Now, you had a question which says, oh, with what number should businesses plan as far as the exchange rate is concerned? There are two things I was taught right at the beginning of my economics studies many, many years ago. Do not predict oil and do not predict currencies, which is why I'm one of those who is most enamored of hedging instruments. And so anybody who's a figure, I think institutions like yours, who are used to acting as counterparties and managing these risks, should be in a good position to advise on what your expectation of market rates should be. Sorry, I can't hear you. I'm not sure if you can hear me. I hope you can hear me, but I can't hear you.
Sorry, can you hear me now?
Yes, now I can.
Yeah, so I was laughing at you directing it back to us as the bank. I mean, our clients, obviously, I mean, we try as often as possible to give them our views,
Exactly.
basically as to where we think the exchange rate should be, and I will continue to do that basically as we see the market evolve. Like you rightly said, a lot of it is dependent on how the CBN decides to manage it at that particular time, and that could change at any given time. So as an economist too, I'm always very cautious of that.
Well, it would
So
actually be useful, at least given that your clients are on the call at the moment. If you just, at least those of us who have to buy, who have foreign currency transactions, if you were to share your own insight as to what you expect the rate to be, then I might be well guided.
so I mean, you're putting me on the spot here. But I mean, I think I'll deflect to you. I think that it will be largely dependent on how the CBN decides to manage it. I think it is obvious that the CBN, and he has re-emphasized that exchange rate stability is key, and it is priority. I mean, and the only rate that seems to be far off from where the CBN wants it to be is the parallel market, obviously. But the CBN even has said time and again that market, one, is shallow, two, is not a real market that most people should focus on, and in quotes, is a market for corrupt practices that as well. But we think to the extent that the global economic environment continues to recover the way we are seeing it, and oil prices maybe keep their head above water. I mean, if we continue to see it recover above the $40 per barrel, then that might give the CBN some more ammunition to be able to keep the currency stable. And not to mention, of course, still the borrowings for the multilateral agencies that could help beef up the foreign reserves as well. That would be supportive. I think those are, just to summarize it, Doctor, those are my views on the currency. So we'll move on, Dr. Salami, now to monetary policies. So there's, I mean, there are quite a number of questions as well, and clients trying to understand how, the CBN still continues to, debit banks effectively significant amount of money for CRR, far above even what is prescribed by the MPC. And at the same time, the CBN is trying to stimulate growth, of course, by trying to push funding to critical sectors of the economy. And I guess one key question is, what should policymakers be doing to encourage capital formation in a low interest rate environment, but a high inflation environment? And I guess the second part of that question, Doctor, if you could take them together, is what is your view as regards, the current interest rate bifurcation that we've seen in the market, and what do you think that policy is sustainable given the nature of our capital accounts? Thank you.
All right. Your first question on capital formation in a low interest rate, high inflation economy already tells you the nature of the difficulty that you face. Everybody, and this is not a Nigeria specific scenario, everybody is looking for low interest rates. But don't forget, basic economics is very, very clear. There are probably three determinants of interest rates. There is the risk of asset erosion, which is essentially inflation. There is the balance of demand and supply. So if supply is in excess of demand, it puts it puts the pressure for lower interest rates on. And then there are, shall we say, there are specific risks that we take into account. And so when you're looking and you're saying, oh, we want low interest rates, the way you're going to get low interest rates, if you want it to be sustainable, is we're going to have to reduce inflation. And before you say to me, oh, a reduction of inflation could mean a more austere stance by the central bank, I always try to challenge people to think about inflation as the balance of demand and supply. And so really, What you're looking for is to see whether or not we can actually stimulate the supply side of the economy to reduce inflation. Let me give you an example. Remember I said earlier that our agriculture, that food, is 50% or slightly over 50% of the of the basket, of the inflation basket. Imagine today, Nigeria is currently in our agriculture, post-harvest losses, depending on which crops or which sector of agriculture, range between 40 and 60% post-harvest losses. In other words, we actually cultivate and then we, for all sorts of reasons, storage difficulties, routes to market difficulties, we lose between 40 and 60%. Now, a friend who's done some work was saying to me, that is the equivalent, I think, and I hope I get this figure right. If I'm wrong, please forgive me. But I think the figure was supposed to be somewhere around about 9 million acres of land's worth of cultivation is what we lose. So for me, one of the ways by which inflation comes down, and which is my own preferred way, is to say, how do we stimulate the supply side? And there are certain value chain challenges that we need to resolve. That, for example, as I just mentioned, post-harvest losses. You deal with post-harvest losses and you probably solve 2 or 3 problems simultaneously. 1, you increase supply and enhance food security. 2, by increasing supply, you enhance farmer incomes. And so for me, when you say we want low interest rates in a high inflation environment, sorry, my own limited understanding of economics kind of says those two don't go together, except for very, very short periods of time, very, very short periods of time. And for us, it is to deal with some of the structural challenges that underlie and hinder our productive capacity, will take us into an environment where the supply side is more responsive and inflation pressures are able to come down, which is why, again, I go back to my earlier comment that this crisis is a useful opportunity to press the reset button in terms of some of our long-standing challenges. Okay, now you speak about the bifurcation of the market. Well, any market doesn't like this kind of arrangement. But again, remember the point I made right at the outset, that Nigeria came into COVID-19 with a challenge, or well, not actually a challenge, a series of challenges. Not least was we were just recovering from recession. We were about a year out of recession, a year, 18 months out of recession, and all of a sudden we are stuck again. But one of the things that had become apparent even pre-COVID-19 was the weakness of our external account. And so the measures that have resulted in bifurcation were measures designed to address that. For me, what I will, in fact, when the central bank said, oh, it wanted OMO to be between, that it was going more conservative in its deployment of OMO, I was actually hoping that it would go the full hog. In other words, OMO would be devoted simply to liquidity management. In other words, OMO would be restricted probably to tenures. And this is my own personal opinion, so don't confuse this with anything else. That I was hoping that OMO would be restricted in terms of even its tenure, but also in terms of those who could participate in it. In other words, the deposit money banks and the central bank, with almost serving the purpose, which in the most conservative definitions of OMO is what it's supposed to be, liquidity management. So probably short tenure, 90 days, 180 days tops, but only between the central bank and the deposit money banks. Now, what we have seen is certainly the deposit money banks, but the central bank has then said, well, you know what, we need the international foreign portfolio investors to be invested in OMO because the rates are this. But one of the challenges we now face is the challenge around capital flight, that notwithstanding relatively high rates, you mentioned the point about international capital wishing to leave. And so for me, these, and I said earlier that in order for us, our key challenge right now are two. One, staunch the outflow of capital, whether it's domestic money or international money. Two, put ourselves in a position to be able to attract inflows, significant inflows. And for me, these sorts of short-term measures that were designed for certain things would need to be reviewed to ensure that they are now not a hindrance to the kinds of flows that I had spoken about.
Thank you very much, Dr. Salami, for that. I mean, we're fast running out of time, so I'll just take maybe a couple more questions and we'll end it there. But just to your point on stimulating, foreign private investment or investment in general, I mean, there's a question here about what do you think are the mechanisms to, one, attract those investments, and second, to protect and sustain those investments?
Well, I think Nigeria has to certainly, start thinking about some things that we weren't doing before now, and trying to see, to what extent we may be able to deploy those in terms of, our arsenal to. But don't forget, what is investment? Investment is what you have to make today in order to attract a return in future. And so there's a risk, there's a time risk. And our key challenge in Nigeria has been, but must cease to be, that risk that is perceived of us, that, oh, yeah, you can get short-term returns that are high, but as far as medium to long term is concerned, Nigeria is a risky environment. And I think one of the things we could actually start thinking about is, to what extent do we use guarantees, leverage the balance sheet of the government to, or the sovereignty of the government to offer guarantees with respect to certain types of investment? Because I think if we are not clear, you see, a country like ours, if we say, oh, let us build international trust, you don't build it overnight. It takes time. And that is exactly what we haven't got, time. We need, in the shortest possible time, to attract as much investment. And so you're going to have to start thinking of what kind of legislative arrangements do you have that are protective of investments? What kind of policy arrangements? Indeed, I would be one of those who would certainly say to you, even our regulators, you see, the world does not revolve around IGR. It's important. Generating revenues are important. But growing sectors, growing markets, and one of the challenges that I think our regulatory environment needs to think about is that challenge around sector market development. If we are not careful, we are in danger of being perceived that regulators across the board are not focused on market development. And yet, for me, anything that focuses on the development of the market, that focuses on the reduction of investor risk, would place Nigeria in a position to attract international, domestic and international investment. In other words, all I'm saying is, look, and I've said this time and again in the course of this conversation of ours, first level, keep what you got. Second level, attract what is outside. In other words, mobilization. And so, for me, legislation, policy, regulation, these three must work in sync to reduce uncertainty, to give investor comfort as a way that Nigeria is a safe place in which to invest.
Thank you very much, Dr. Salami. Just one final question before I invite the head of global markets, Sam Ochel, to give the closing remarks. And the question is pretty straightforward. So what are the key sectors that you think can attract this foreign capital that you're talking about in the country? I mean, there's a follow-up question there that still talks about, or for instance, given the fact that unemployment is still rising in the country, the real estate sector has not been growing. What do you think can be done to encourage that sector, or to push that sector back up, and also around the agri sector as well? So basically, what are the key sectors that you think can attract this foreign capital, and when they come in, would be able to drive growth more substantially?
Okay, now as an economist, one of the things that I enjoyed the pleasure of is to be able to deploy frameworks that enable you to think through answers rather than just cherry picking, oh, this sector, that sector, the other sector. And there are a couple of things that I am clear about in terms of a framework that helps you say, okay, where might there be opportunities? Because that's essentially the question that you're asking. But before I go into that, you also raised as an addendum, real estate. The challenge for real estate is a very simple one. The economics of real estate at the moment are difficult, and until they improve, then it's difficult to see how the sector really moves on. But its economics will improve as the fortunes of the economy itself improves. Don't forget, a high interest rate environment is not one that really supports the real estate environment. So again, I go back to my earlier point. We need to stimulate the supply side of the economy in order to be able to reduce inflation as a way of getting interest rates down. Right. Now, coming back to the broader question, where might there be opportunities? There are a couple of things that I usually invite people to reflect on. First of all, where is the biggest amount of activity in the economy? In other words, which are the biggest sectors of the economy? Second of all, where is the largest amount of new activity taking place in the economy? In other words, which are the fastest growing sectors of the economy? Third, where do people spend money? Where do people spend money? One of the things my colleagues and I in our little shop did a survey in 2018 in Lagos and discovered that, and I honestly was very surprised about this, that in Lagos, 11% of household spending is on eating out. And so when you're starting to ask yourself, oh, which are the sectors? As I said, where is the largest amount of activity? Where is the largest amount of new activity, in other words, growth? Where is where are people spending their money? Where are there deficiencies in the economy? Because deficiencies also point to opportunities. These, for me, now, so if anybody is saying to me, hey, so where should I go? Okay, if you were to ask me, Doyin, if you are going to invest and say 20 years from now, you'd be satisfied with your investment, where would you go? I'm clear in my mind. Go and buy land near water. Why? Well, people have to be fed. If as the United Nations tells us that there are potentially, or Nigeria's population potentially gets to 411 million by 2050, then that's a heck of a lot of human beings that have to be fed. And so any which way, agriculture certainly does it. Any which way, the challenges around logistics, we don't have the rail network where, as I'm told, and I again hope I am right on this, I am told that the volume of traffic, of haulage that goes by road is probably 15, 20 times the size of whatever goes by rail. And so, but as the infrastructure network expands, then you can, and all of us are familiar with rail networks being built, across the country. So no way that I'm looking at it and I'm thinking to myself, see, agriculture certainly, and as agriculture improves, especially post-harvest losses, I'm clear about its role in the manufacturing value chain as an input. I'm clear about the role of technology. I'm clear about the role of distribution. Now, given the nature of our population, don't also forget, it's a very youthful population. Healthcare is going to be, actually, let me call it human capital development, which is going to be a combination of healthcare and education, are going to be very important. And one final point. Ahead of the recession in 2016, one of the things we had been seeing in Nigeria had been an evolution where household spending was evolving from what we will call subsistence. In as recently as 2003, almost 2/3 of household spending was on food. By the time we looked at the numbers for 2009, the figures suggest that that had dropped to about 52, 53%. Recession appears to have shifted us back into people spending more on food to the detriment of other things. But my view is that as the economy grows and development attends Nigeria, we will see a further evolution away from food, away from subsistence to lifestyle. And one of the areas that I have absolutely no doubt in my mind, as I said, health, human capital, healthcare, and education. Our survey in 2018 showed that in Rivers State, I think it's either 13 or 18% of household income was being spent on education. It's either 13 or 18. Forgive me. I will include the numbers in the deck that will be sent to you. And so, what is clear is that we are seeing a shift in how people are spending, and I think that shift, anybody who is able to track that shift won't go too far wrong. Thank you very much indeed.
Thank you very much, Dr. Salami. Thank you. Very insightful presentation and very insightful engagement as well. Thank you as well to the participants that sent in their questions. Apologies, we're not able to get through all of them, but we'll try as much as possible to take them and see by how much we can answer some of them and respond to it. Thank you very much. At this juncture, please invite with me the head of our global markets, Stanbic IBTC Bank, Mr. Sam Ochelo, to give the closing remarks. Thank you very much.
Okay. Good afternoon, all. I would like to thank Dr. Doyin Salami for taking out time out of his busy schedule to deliver this presentation today. There is no better opportune time to look ahead than now. Thank you for the insight into the country's economic outlook as you see it from your lenses as an industry professional and renowned economist in Nigeria. I'm sure it will help our customers and clients to make better and more informed decisions going into the second half of the year. So thank you once again, Dr. Salami, for this valuable insight. And to our clients and customers, undoubtedly, 2020 has been a challenging year given the COVID-19 pandemic and disruption to economic activities. But as a reliable and valuable partner, we have been trying to weather the storm together, and we have no doubt that this too will pass and the world even become a much better place. At the core of our mandate as a financial institution is client centricity. And this is one of the avenues by which we show that providing you with valuable insight from top professionals in the industry and even from staff members who are your RMs. Like our new mantra says, it can be, which simply means whatever may be your dream or aspiration with Stanbic IBTC as your valued partner, it surely can be. We can together help make your dream come true. So once again, I will like to, on behalf of the management of Stanbic IBTC Holdings, express our deepest gratitude to all our clients and customers on this webinar today. Thank you for trusting and believing in us. Thank you for joining today's session. I mean, we have over 530 people on this call, which is something that is very great. So we'd like to say thank you very much for joining the webinar today. And please feel free to reach out to any one of us through your relationship managers if you have further queries, and we'll be willing to support you with answers. Thank you very much.
Thank you very much, everyone. We have now come to the end of the session. Please stay safe out there and have a good evening. Thank you very much.
Yes, thank